Where did you?
Silver punches through $15 for first time since Nixon closes the gold window anniversary. Silver has punched through $15, nearly erasing all losses from the August 15th beatdown. The gold chart isn't too shabby either. Here are the details. Silver has just punched through the $15 price level. This is even before the opening bell. Let's see if silver can get put in a close above this psychologically important whole number. The last time 1 ounce of silver cost $15 was on August 15, 2018, and that day was the anniversary Nixon closing the gold window. Here's a look at silver's daily chart. That August 15, 2018 candle was a 71-cent loss on the day. Look closely on silver's daily chart, however, and you will see that silver just put in the all-important higher high, at least on an intraday basis. Gold is not too shabby either right now. In fact, gold is within spitting distance of finishing the year and ch unchanged. That is amidst a stock market decline, the oil bust 2.0, and a housing market bubble that is clearly popping. Gold is now down just over 2% year-to-date. For comparison, the stock market, in this case the S&P 500, is down over 12% year-to-date. Not only is S&P down over 12% year-to-date, but the S&P is down over 20% peak to trough. Being down over 20% is considered a bear market, and that S&P 500 chart looks absolutely terrible. I have been saying for some time that the downside in gold and silver is limited. I am also not expecting a rush in gold and silver prices if the stock market is actually going to crash by some 40% or more. I have been basing my limited downside statement on the rising price of crude oil, but as the year played out, however, it is clear that in late December, gold and silver are in the beginnings of catching their safe haven bids. I have also been saying the window is closing for gold and silver at dirt cheap prices. And that window for silver might have just closed on 14. The endless war on gold and silver, Craig Hemke. There are many reasons to be optimistic for higher gold and silver prices, but Craig explains how the banks are already preparing to fight us at every step. By Craig Hemke at Prod Money News. Last week, we succinctly laid out for you what to expect for the end of this year and into 2019. Though there are many reasons for optimism regarding higher precious metal prices next year, understand that the banks are already taking steps to fight us every step of the way. In case you missed it, here is the post from last week. The key takeaway is that COMEX precious metal prices have rallied into year-end and the first quarter for each of the past 5 years. Expect this year and the first quarter of 2019 to see similar gains. But understand that this isn't going to be all sunshine and lollipops. While other analysts were rejoicing a few months ago and falsely proclaiming that the banks were now long and on the side of precious metal investors, we were quick to point out that that simply was not the case. The banks that make markets on the COMEX were never not long, and they had no intention of lifting sides and adding price run. We laid this out for you back in October, and you should be sure to read these articles again now as new rallies begin. Simply put, the banks are not on your side, nor will they ever be. They've profited for years by controlling open interest, sentiment and price, so you must expect them to continue their efforts in 2019. And we've already seen this play out. For example, over the past few months, the unaged money portion of the Commitment of Traders report for COMEX Gold revealed a massive and unprecedented net short position for the hedge and trading funds that make up this category. As you can see below, at one point in October, these funds were net short 110,000 COMEX contracts for about 340 metric tons of digital gold obligations. If the banks had been on our side, they would have forced these funds to be squeezed in price, as they do not hold 340 metric tons of gold for future delivery. Instead, as you can see below, the entire position was covered as of December 11th with a net change in price of just $47. For all intents and purposes, the banks let the managed money funds off the hook by reassuming the short obligation from them. His can be seen in the latest bank participation report, as well. After drawing all the way down to a COMEX gold NET short position of just 24,079 contracts on the October report, the 33 banks surveyed for the report in December showed a summary position that had already grown back to 88,265 contracts NET short, even though price had rallied just $40 over the same time period. And now, with prices rallying once again, the banks are back to simply playing the same old games they've played for years. This week alone, with the price of COMEX gold up $12 or slightly less than 1% on Monday and Tuesday, the banks have increased the total COMEX gold open interest or load by nearly 15,000 contracts, as shy of 4%. Managing price by managing the supply of contracts is price manipulation 101 for the banks. At TFMR, we wrote the definitive explanation of this back in April of 2017. If you've never read this post, you should definitely do so today. Thus, in summary, while we expect a continuing rally through year-end and into the first quarter of 2019, and though we expect 2019 to be a terrific year for precious metals due to a wide range of factors, one should be under any illusion regarding the COMEX and how it operates. As they've always done in the past, the banks which operate there will fight us every step of the way and tick for tick. The banks are not, nor will they ever be, on your side, and thus no gains will ever come easy.